People typically think a call option and a put option are opposites of each other, and while there is some logic to this way of thinking, this could not be further from the truth. Before we get into it, be sure to subscribe to our channel and click the notifications button so you're always in line for our latest releases. But from a trader's perspective, a call and a put are considered to be the same thing. The reason for this: a long call can always be turned into a long put with the use of stock, and vice versa. A short call can always be turned into a short put with the use of stock, and vice versa. To give you an example, here's our option chain, and we want to do a buy right. Here we will buy 100 shares of stock and then sell the 55 strike price call for $1.25. Let's look at a couple scenarios. First, let's pretend the stock trades up to 58. The stock gets called away, resulting in us hitting our max profit on the trade. Here we would make $5 on the stock, plus we would get to keep the full $1.25 premium we sold the call for. This results in a total profit of $6.25, and the stock would then get called away from us. If we notice, that's the exact price we would have made if we just sold the 55 strike price put to begin with. Had the stock traded to 58, this 55 strike price put would have expired worthless, and we would have kept the full $6.25, the exact same profit as the buy right, and at the end we would still have no stock. Scenario 2. What if the stock traded up to 53? With our buy right, we would end up making $3 on the stock, and the calls would expire worthless, and we would keep the full $1.25 for a total profit of $4.25, and we would still own the stock. Instead, if we would have sold the 55 strike price put, we would have received a premium of $6.25 right from the start. However, the put would have finished with a $2 intrinsic value, so we would have been assigned the stock at a $2 loss. When we combine that with the $6.25 we sold the put for, we would end up with a total profit of $4.25, and we would own the stock, just like our buy right position. Finally, let's work through one more scenario. This time, the stock trades down to $40 per share on expiration. On our buy right, which we bought the stock for $50 and sold the 55 strike price call for $1.25, we would have a $10 loss on the stock and a $1.25 profit on the call, for a total loss of $8.75, and we still own the stock. If we instead would have sold the 55 put for $6.25, we would have to buy the stock for $55. And because that means it has $15 of intrinsic value, we would take a $15 loss on the stock. But because we received a premium of $6.25, we would have a net loss of $8.75, and we would now own the stock. As you can see, in all of these situations, selling a call and buying stock turned out to produce the exact same results as selling the same strike price put, and it will be like this for all strike prices up and down the board. If you sell a call and then buy a stock against it on a one-to-one basis, that is technically the same thing as selling a put, which is why this is actually referred to as a synthetic put. If you buy a call, you can turn it into a synthetic long put by selling stock. If you buy a put, you can turn it into a synthetic long call by buying stock. And if you sell a put, you can turn it into a synthetic short call by selling stock. You can calculate a synthetic call or put with just some basic math. Take the difference between the strike price and the stock price, and then add that to the out-of-the-money options, or subtract it from in-the-money options to get the synthetic price of the opposing call or put. For example, here is Tesla, which closed right at $370 today. If we look at the 375 strike call, that is $5 difference between stock price and strike price. So I would add that $5 to the calls, and that should equal the price of the 375 strike put. And as we can see, it does. If we look at the 355 strike put, that's a $15 difference in stock price and strike price. I then add that to my put price, and that would equal my call price. You may notice that the price is off by a few cents, and that is normal. It will never be exact because there's always going to be interest to consider. The fact is, when we have to buy stock, that ties up much more capital, and that's capital we cannot earn interest on. So in order to account for that, the options prices will be adjusted slightly for interest. If the stock pays a dividend, that will also be adjusted into the option pricing. However, these are topics for another lesson. All right, everyone. I hope you enjoyed this video. Remember to get your free option trading course at optionstrategiesinsider.com.